Hello, and welcome to Edupedia World. Today we are going to discuss employee benefits and services. We are mainly going to be discussing four main types of plans, which is supplemental pay benefits, such as your sick leave, vacation pay, your insurance benefits, such as your workers' compensation and health insurance, retirement benefits, such as pensions, and employee services, such as childcare facilities. Now, because legal considerations loom large in any benefits decision, we're going to cover applicable laws as well. Now, employee benefits. What are your benefits? Is the first thing many applicants ask. So, benefits are basically indirect financial and non financial payments that employees receive for continuing their employment with the company. We had discussed this in the previous chapter, which this comes under the non-financial part of compensation, and these are an important part of just about everyone's compensation, and they include things like health and life insurance, pensions, time off with pay, childcare assistance, and so on. So the benefits which employees get vary distinctly from country to country. So let's go ahead and see what is the employee benefits in India. So employee benefits or perquisites are now an integral part of compensation packages, and the type and extent of perquisites given by Indian organizations are determined by the relevant laws and the location specific practices or requirements, and of course the tax laws as well. Now, as per the Factories Act of 1948, the Plantation Labor Act, the Sales Promotion Employees Act, these mandate that the employers have to provide employee welfare measures for free or at a nominal cost. And the welfare measures are intended to enhance the comfort level of workers, thus increasing their productivity. So the Factory Act stipulates providing welfare benefits like childcare in the form of a creche for children, and healthcare facilities for workmen, and washing facilities, canteen, drinking water, and so on. So if you go into a manufacturing plant, you would find these facilities. If it isn't, then that's against the law. Now, other legislations for social security benefits like Provident Fund, healthcare insurance, gratuity, etc., also exist in India. And in addition to that, many Indian firms provide additional benefits like soft loans to employees, and these include housing, transportation, schooling, etc. And while the law on benefits does not include managerial employees, firms have extended the benefits to managers too. And the attraction of public sector and government employment, even though the salary levels are much below the MNCs in the private sector, they have benefits like residential township with facilities for recreation and entertainment. They have high quality schools where children of employees are guaranteed admissions. There are company run hospitals or contacts with leading hospitals. And attractive benefits are also offered by MNCs and private employers. And the wide range of benefits offered by, let's take an example of Tata Group. We had discussed that in chapter 1, right? And MNC software like Accenture India offers a wide range of employee benefits to suit employee needs, business requirements, and local laws. The company focuses on the health and well-being of employees. They have created a gym at the office so that employees are saved the trouble of driving down to a private gym. Facilities for indoor sports like table tennis, carom, high-tech gaming facilities are available within the company. The company is among the growing number of organizations that encourages flexible timings and work from home facilities. So employees and their families are invited for celebrations, and the company also has days meant for bringing family members to the office. Now, employers therefore need to design benefits packages with care. And a short list of policies issues would include what benefits to offer and who receives coverage, and whether to include retirees in the plan, whether to deny benefits to employee during the initial probation period, and how to finance benefits. The degree of employee choice is in determining benefits, and a lot of things that you need to look at when you design your benefits package. And there are various ways to classify them, and we will classify them as pay for time not worked, insurance benefits, retirement benefits, and employee services. So let's start and discuss what pay for time not worked means. So, pay for time not worked, also called supplemental pay benefits, is the most costly benefit because of the large amount of time off that most employees receive. And common time off with pay periods include holidays, vacations, jury duty, funeral leave, military duty, personal days, sick leave, sabbatical leave, maternity leave, and unemployment insurance payments for laid off or terminated employees. So let's start with what unemployment insurance means. So all states have unemployment insurance or compensation laws, and these provide benefits if a person is unable to work through no fault of his or her own. And the benefits derive from a tax or employer that can range from 0.1% to 5% of taxable payroll in most states. And an employer's unemployment tax rate reflects its rate of employee terminations. So states have their own unemployment laws, but they all follow federal guidelines. And firms aren't required to let just everyone they dismiss receive unemployment benefits. Only those released through no fault of their own. Thus, strictly speaking, a worker fired for chronic lateness, right? Or if he's not performed as an underperformer, or for any proper reason, can't legitimately claim benefits. So employees therefore spend thousands of dollars on unemployment taxes that would not be necessary if they protected themselves. So the main rule is to keep a list of written warnings, right? And also make sure that you can answer yes to most of the questions, like do you have a rule that 3 days absence without calling is a reason for automatic discharge, and actions like these should enable you to demonstrate that the dismissal was a result of the person's inadequate performance. So you need to be very careful before you let an employee go, and make sure that it is legally done. So vacations and holidays, that is another kind of pay for time not worked. Now most firms offer vacation leave benefits, and 84% of human resource professionals said their firms offer paid vacation for employees, and 51% offer paid personal days. On average, American workers get 8.9 days of leave after 1 year's employment, and days off rise to about 11 after 3 years, 14 after 5 years, and 16 after 10 years. Elsewhere, vacation allowances vary from 6 days in Mexico to 10 days in Japan to 25 days in Sweden, about 25 days in India as well. The most common US paid holidays include New Year's Day, Memorial Day, Independence Day, Labor Day, and so on. Sick leave provides pay to employees when they're out of work due to illness, and most sick leave policies grant full pay for a specified number of sick days, and usually up to about 12 per year. And the sick days usually accumulate at the rate of, say, 1 day per month of service. And sick leave causes trouble for employers because the problem is that while many employees use their sick days only when they are sick, others use it for personal leave, whether it's sick or not. And in one survey, personal illness accounted for only about 45% of unscheduled sick leave absences. Family issues was about 27%, personal needs 13%, and a mentality of entitlement that was 9%. And these were the other reasons cited. And one survey found that the average cost of absenteeism per employee per year was $789, with personal illness accounting for about a third of the absences. So basically, you need to keep a couple of cost reduction tactics in mind when you basically plan your benefits package, right? Now, parental leave and the Family and Medical Leave Act. So, parental leave is an important benefit. About half of the workers are women, and about 80% will become pregnant during their work lives. So, furthermore, many women and men head single parent households, and under the Pregnancy Discrimination Act, employers must treat women applying for pregnancy leave as they would any other employee requesting a leave under the employer's policy. Beyond this, Congress passed the Family and Medical Leave Act of 1993. Among other things, the Act stipulates that private employers of 50 or more employees must provide eligible employees up to 12 weeks of unpaid leave for their own serious illness, the birth or adoption of a child, or the care of a seriously ill child, spouse, or parent. Employers are also required to let employees take any unused paid sick leave or annual leave as part of the 12-week leave provided in the law. Then we have employees are also entitled to take to receive health benefits while they are unpaid leave under the same terms and conditions as when they were on the job. And employers must guarantee most employees the right to return to their previous or equivalent position with no loss of benefits at the end of the leave. Then we have severance pay. Now, many employers provide severance pay. It's a one-time separation payment when terminating an employee. Severance pay makes sense. It is a humanitarian gesture and good public relations. In addition, most managers expect employees to give them 1 or 2 weeks' notice if they can plan to quit. So it seems appropriate to provide severance pay when dismissing an employee. Reducing the chances of litigation from disgruntled former employees is another reason. Severance pay plans also help reassure employees who stay on after the employer downsizes its workforce that they'll receive some financial help if they are let go too. So for whatever reason, severance pay is common. In one survey of 3,000 human resource managers, 80% of responding organizations reported having a severance policy. The reason for dismissal affects whether the employees get severance pay. About 95% of employees dismissed due to downsizing got severance pay, but only about a third of employers offer severance when termination is for poor performance. It is uncommon to pay when employees quit, and the average maximum severance is 39 weeks for executives and about 30 weeks for other downsized employees. Now, insurance benefits. Most employers also provide a number of required or voluntary insurance benefits such as workers' compensation and health insurance. Now, workers' compensation laws aim to provide sure, prompt income and medical benefits to work-related accident victims or their dependents, regardless of fault. Every state has its own workers' compensation law and commission. The workers' compensation law aims to provide sure, prompt income and medical benefits to work-related accident victims or their dependents, and regardless of fault. So every state has its own workers' compensation law and commission. and some run their own insurance programs. So, how are these benefits determined? So, workers' compensation can be monetary or medical. And in the event of a worker's death or disablement, the person's dependents receive a cash benefit based on prior earnings, usually one half or two thirds the worker's average weekly wage per week of employment. And most states have a time limit, such as 500 weeks, for which the benefits can be paid. And if the injury causes a specific loss, such as an arm or a leg, the employee may receive additional benefits, such as based on statutory list of losses, even though he or she may return to work. In addition to these cash benefits, employers must furnish medical, surgical, and hospital services as required for the employee. So, for workers' compensation to cover an injury or work-related illness, one must only prove that it arose while the worker was on the job. It does not matter that he or she may have been at fault. If the person was on the job when the injury occurred, he or she is entitled to workers' compensation. So, for example, suppose you instruct all employees to wear safety goggles when they're working with their machines, and one worker does not listen to the instruction, and he or she experiences an eye injury while on the job, then the company must still provide the workers' compensation benefits. So, how do you control workers' compensation costs? So, there are several ways to reduce these workers' compensation claims. So, one is to screen out accident prone workers, reduce accident causing conditions in your facility, and reduce the accidents and health problems that trigger these claims. Also, supervisors should watch for typical fraudulent claim red flags. Case management is a popular cost control option. It is the treatment of injured workers on a case by case basis by an assigned manager, usually a registered nurse who coordinates with the physician and health plan to determine which care settings are the most effective for quality care and cost. Then we have the hospitalization, health, and disability insurance. Now, health insurance looms large in many people's choice of employer because it is so expensive. So, 75% of employees in one recent survey called it their most important benefit. And hospitalization, health, and disability insurance helps protect employees against hospitalization costs and the loss of income arising from off the job accidents. Then we have long term care. Now, today, baby boomers are entering their 60s, and long term care insurance to support things like nursing assistant to former employees in their old age is a key employee benefit. The Health Insurance Portability and Accountability Act of 1996 lets employers and employees deduct the cost of long-term care insurance premiums from their annual income taxes, making this benefit more attractive. So, employers can provide insurance benefits for several types of long-term care, such as adult daycare, assisted living, and custodial care. Then we have life insurance. So, in addition to hospitalization and medical benefits, most employers provide group life insurance plans. And employees can usually obtain lower rates in a group plan. And group plans usually accept all employees, including new non-probationary ones, regardless of health or physical condition. So sometimes the employer pays 100% of the base premium, which usually provides life insurance of equal to about 2 years' salary. The employee then pays for any additional coverage, or the cost of the base premium is split between employer and employee. Now, retirement benefits, right? Two challenges for employees. First, that we discussed in chapter 10 of careers. Employers are taking steps to entice older workers to keep working in some capacity. Second is retirement funding is a big issue. And we're going to focus here on retirement benefits, including Social Security, employee pension plans, and the 401k. Now, most people assume that Social Security provides income only when they're older than 62, but it actually provides three types of benefits. The familiar retirement benefits provide an income if you retire at age 62 or thereafter are insured under the Social Security Act. Second are the survivors or death benefits. These provide monthly payments to your dependents regardless of your age at death. Again, assuming you are insured under the Social Security Act. And finally, there are disability payments. These provide monthly payments to employees who have become disabled totally and to the dependents if they meet certain requirements. So, the full retirement age for non discounted Social Security benefits traditionally was 65, the usual age for retirement. It is now 67 for those who are born in 1960 or later. Coming to pension plans are financial programs that provide income to individuals in their retirement. About half of full-time workers participate in some type of pension plan at work. However, the actual rate of participation depends on several things. For example, older workers tend to have a higher participation rate, and employees of larger firms have participation rates as much as 3 times as high as in small firms. We can classify pension plans in 3 ways. We have contributory versus non-contributory plans, qualified versus non-qualified plans, and defined contribution versus defined benefit plans. The employee contributes to the contributory pension plan while the employer makes all the contributions to a non-contributory plan. And employers derive tax benefits from contributing to qualified pension plans, such as tax deduction for the pension plan contributions. Now, defined benefit plans. With defined benefit pension plans, employees know ahead of time the pension benefits they will receive. And the defined pension benefit itself is usually set by a formula that ties the person's retirement pension to an amount equal to a percentage of the person's pre-retirement pay. And that is multiplied by the number of years he or she has worked for the company. Now, defined contribution plans, on the other hand, they specify what contribution the employee or the employer will make to the employee's retirement or savings fund. With a defined benefit plan, the employee knows what his or her retirement benefits will be upon retirement. And with a defined contribution plan, the person's pension will depend on the amounts contributed to the fund and on the retirement fund's investment earnings. Next, we have the 401k plans. The most popular defined contribution plans are based on the section 401k of the Internal Revenue Code. And the employee authorizes the employer to deduct a sum from his or her paycheck before taxes and to invest it in the bundle of investments in his or her 401k. And the deduction is pre-tax, so the employee pays no tax on those dollars until after he or she retires or removes the money from the 401k plan. And the person can decide to deduct any amount up to the legal maximum. And the employer arranges usually with an investment company such as Fidelity Investments to administer the 401k plan and to make investment options available to the plan. Other defined contribution plans. The 401k plan is one example of a savings and thrift plan. In any savings and thrift plan, employees contribute a portion of their earnings to a fund, and the employer usually matches this contribution completely or in part. So, employers use a deferred profit sharing plan to contribute a portion of their profits in cash to a pension fund, regardless of the level of employee contribution. An employee stock ownership plan is a qualified tax deductible defined contribution plan in which employers contribute stock to a trust for eventual use by employers who retire. Now, pension and early retirement. To trim their workforces or for other reasons, some employers are encouraging employees to retire early. Many of these plans take the form of early retirement window arrangements for specific employees, often the age of 50 plus. And the window means that for a limited time, the employees can retire early. The financial incentive is generally a combination of improved or liberalized pension benefits plus a cash payment. Now, early retirement programs can backfire for two reasons. Some are too successful. When Verizon Communications offered enhanced pension benefits to encourage that what it hoped would be 12,000 employees to retire, more than 21,000 took the plan, and Verizon had to replace 16,000 managers. So, discrimination is the other potential problem. Unless structured properly, older employees can challenge early retirement programs as de facto ways for forcing them to retire against their will. Although it is generally legal to use incentives to encourage individuals to choose early retirement, the employee's decision must be voluntary. Now, employee services. So, many employers provide the sorts of personal services that employees need at one time or another. And these include credit unions, legal services, counseling, and social and recreational opportunities. And some employers use the term voluntary benefits to cover personal services benefits that range from things like pet insurance to automobile insurance. Now, credit unions are usually separate businesses run by independent companies to help employees with borrowing and saving needs. But some employers establish their own um, credit unions, and employees usually become members by purchasing a share of the credit union stock for a small fee, perhaps $5 or $10. And members can then deposit savings that accrue interest at a rate determined by the credit union's directors. And loan eligibility and the loan's rate of interest are usually more favorable than those of banks and finance companies. Then we have the employee assistance programs. These provide counseling advisory services such as personal, legal, and financial services. They also provide child and elder care referrals, adoption assistance, mental health counseling, and life event planning. And EAPs are increasingly popular with more than 60% of larger firms offering such programs. So, one study found that personal mental health was the most common problem addressed by employee assistance programs. Um, then we have family friendly work life benefits. Several trends are changing the benefits landscape. There are more households where more adults work, more one parent households, more women in the workforce, and more workers older than age 55. Then there's the time bind people working more without the time to do all they'd like to do. And the issues solve working men as well as working women. And these pressures have led many employers to bolster their family friendly benefits. And the number of Americans who have never married is rising, and the newer work life benefits terminology recognizes the need to improve all employees' work life situations, not just with families. So, these benefits include childcare, elder care, fitness facilities, flexible work schedules, benefits that help employees balance their family and work lives. So, for example, a survey by the Society of Human Resource Management found that 29% of employers provided at least some type of childcare assistance, and 55% offered flexible schedule work managements. Um, then we have the executive perquisites. And when you reach the pinnacle of the organizational pyramid, or at least close to the top, you will find waiting for you the executive perk. So, as we had discussed perks in short during the previous chapter, usually these go only to the top executives, and perks range from substantial company planes or golden parachutes, management loans, all the way to relatively insignificant things like private bathrooms, season tickets, and so on. So many popular perks fall between these extremes. These include management loans, which typically enable senior officers to exercise their stock options, salary guarantees, also known as golden parachutes, to protect executives if their firms become targets of acquisitions or mergers, financial counseling to handle investments, and relocation benefits, often including subsidized mortgages, purchase of the executive's current house, and payment for the actual move. A selection of other executive perks include time off with pay, including sabbaticals and severance pay, outplacement assistance, company cars, chauffeur limousines, executive dining rooms, physical fitness programs, legal services, tax assistance, club membership, children's educational subsidies. As you can see, employers have had many ways of making their hardworking executives live as pleasant as possible. Now comes the flexible benefits program, right? And employees prefer choice in their benefits plan. And in one survey of working couples, 83% took advantage of flexible hours, and 69% took advantage of the flexible style benefits that we will discuss next. And 75% said that they prefer flexible benefit plans. Um, so coming to which this particular approach is called the cafeteria approach, which is the flexible benefits approach. So one way to provide a choice is with an aptly named cafeteria benefits plan. So specialists use flexible benefits plan and cafeteria benefits plan synonymously. And a cafeteria plan is one in which the employer gives each employee a benefits fund budget and lets the person spend it on the benefits he or she prefers, subject to two constraints. First, the employer must, of course, limit the total cost of each employee's benefits package. Second, each employee's benefits plan must include certain required items, for example, social security, workers' compensation, and unemployment insurance. There are different types of plans. So, cafeteria plans come in several varieties. And to give employees more flexibility in what benefits they use, about 70% of employers offer flexible spending accounts for medical and other expenses. And this option lets employees pay for certain benefits expenses with pre-tax dollars. And to encourage employees to use this option without laying out cash, some firms are offering debit cards that employees can use at their medical provider or pharmacy. We have other flexible work arrangements. Flexi time. Flexi time is a plan whereby employees' work days are built around a core of midday hours, such as 11 a.m. to 2 p.m., and workers determine their own starting and stopping hours. So, for example, they may opt to work from 7 a.m. to 3 p.m. or from 11 a.m. to 7 p.m. And the number of employees in formal flexi time programs from 4% of operators to 17% of executive employees doesn't tell the whole story. So many more employees, probably almost half, actually take advantage of informal flexible work schedules. In practice, most employers hold fairly close to the traditional 9 a.m. to 5 p.m. workday. And therefore, the effect of flexi time for most employees is to give them about 1 hour of leeway before 9 a.m. or after 5 p.m. Then we have the compressed work weeks. Now, many employees, like airline pilots, do not work conventional 5-day, 40-hour work weeks. Similarly, hospitals may want doctors and nurses to provide continuing care to a patient, or manufacturers may want to reduce the productivity lost whenever workers change shifts. Firefighters usually work for several days straight, and workers like these typically have compressed work week schedules, which mean they work fewer days each week, but each day they work longer hours. So, non conventional work week come in many flavors. Some firms have 4-day work weeks with four 10-hour days. Some workers in hospitals, for instance, work three 12-hour shifts and then are off for the next 4 days. Um, then we have something known as job sharing and work sharing, right? So the difference is job sharing allows two or more people to share a single full time job. For example, two people may share a 40-hour per week job, with one working in the mornings and the other working afternoons. And about 22% of the firms questioned in one survey indicated that they allow job sharing. And job sharing can be particularly useful for retirement aged employees, in that it allows them to reduce their hours while enabling the company to return their expertise. Now, work sharing refers to a temporary reduction in work hours by a group of employees during economic downturns as a way to prevent layoffs. So, thus, 400 employees may all agree to work and be paid for only 35 hours per week to avoid a layoff of 30 workers. Now, this brings us to the end of the chapter. Thank you so much for listening in. In the next session, we would be discussing ethics, justice, and fair treatment in HR management. This comes under the Employee Relations unit, which is going to be our final unit for the subject. I hope you enjoyed the session and have a good day.